of the dishonored note plus interest for 46 days beyond the maturity date. So, whew, they paid us. All right, so that means that we got the money now, so cash is affected. So cash is a debit balance, so we're going to do the same thing to it, which in this case would be another debit. Once again, I don't know how much we got yet because we charged interest on it. So now we're going to credit something in this case, and in this case we put it back into the receivable. So we can see how much do they owe us, the receivable. Now they owe us 3822. So we're going to say, okay, so the receivable is going to have to go down. That's a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit for what is in there in this case, which is the 6309. So we're going to say that's going to be a credit for the 6309. And then it says that he paid us interest on that amount. So if we calculate the interest, we did that calculation over here in advance again. So we had the 6309 times the 7% is the interest here, and we broke that out. And so now we're saying that there's another 56 he's going to pay in interest, even though it was in receivables at this time. So we're going to say that we had interest revenue. We earned some more revenue by loaning money out, and that revenue being another $56. Therefore, they owed us this much plus the interest we had last time, plus the interest he owes us this time. He owes us the 6365. And once again, we could do that with a negative sum function. That will be the debit then, the 6365. So then we can post this out. So I'm going to go to cash. I'm going to double click on it. Note, you can also hit F2 if you hit F2, and then you can say plus, and if you hit F2 again, you can stop using the mouse and just use the keyboard here. So and then hit enter, and then once again I could then I have to record the accounts receivable. I'm up here, and again I could double click on it, or I can hit F2 and I'm on the end of it, plus F2, and then use your down keys and then go down to the receivable, and that's going to make the receivable go down up here. So I say enter. And then we're going to go to the interest revenue. So interest revenue is here. We can double click on it, or we can hit F2 plus. And then again, if I use the arrows before I hit F2 again, it's stuck in here. So if I hit F2, then I can go down to the revenue and enter. Now note we recorded the receivable again, and we're out of balance on the receivable over here. So this was for midnight. So now midnight receivable is a credit. So in the credit column, we're going to credit that, enter, and that puts us back in balance, meaning the subsidiary matches over here. So we have a couple more journal entries, which means we're going to have to unhide here. So notice it goes D, E, G, H, I, J, K, Q, R. So we're going to put our cursor on the K, hold down, and scroll over to the R, let go, right-click on the highlighted area, and unhide. And we can post a few more of these transactions here. On 8/7, accepted a 8850 90-day 10% note dated this day in granting a time extension on the past due accounts receivable from Mulan. All right. So Mulan over here is in the receivable, and we could say that owes us the 8850. We need to that's included in here. We need to make that go down, and we're going to say that we're putting it into a note. So once again, they didn't pay us. We're going to say that's fine. We're going to have you sign a note, and we'll just charge you interest on it, and that will how we'll deal with it. So that's a credit. That's a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit, and it's going to be for the amount that is owed to us of the credit 8850. So we're going to have to debit something 8850. What are we going to debit? We're going to put it into the receivable here. So now we moved it out of the accounts receivable. We're going to debit the notes receivable, and we can post that out. So we can go to notes receivable here in T10 equals the debit, making this amount go up in the debit direction here. And then we're going to double click on the accounts receivable, double click it, go to the end of it, plus, and we're going to make that go down here. And we also need to reflect that in the subsidiary ledger. No longer owes us money, Mulan, so we're going to put it in the credit equals the credit here, and that should bring us down here. This goes back in balance. This is back in balance here. See, take a look at the next transaction that happens on 9/3. Accepted a 2150 90-day 9% note dated and granted for Carson a time extension. Same thing. So Carson didn't pay us. So Carson owes us this 2150. and they didn't pay us, therefore we're going to have to make that go down. So that's receivable, we're going to have to make it go down. That's a debit, we're going to make it go down by doing the opposite thing to it, which means we're going to put it on the bottom for a credit of 2150, and we're going to debit something for 2150, and the debit's going to go to the receivable from Carson, which is also a debit balance account. It's an asset. We're going to make it go up by doing the same thing to it, which in this case will be another debit. So then if we post that out, I'm going to put my cursor in T8 equals the debit, making this amount go up in the debit direction to here. Then we're going to go to the receivable, double click on it, go all the way into it. I know there's a lot in there, and say plus, and we're going to go to the credit in this case, making it go down. Now we're in balance here, but we're out of balance here. We're going to go to Carson, no longer owes us money. So in the credit for Carson equals the credit receivable here. And that means that our subsidiary ledger now matches our trial balance. All right, so now we are on 11.2, receive payment plus interest from Carson. All right, so Carson now paid us. So we could say, well, is cash effective if Carson now paid us? Here's what Carson owes us in the note now, and now he paid us. Cash has a debit balance, and we're going to make it go up because he paid us the cash. So we're going to debit cash. I don't know how much we got yet because we're going to have to calculate the interest, but I do know he paid off this note, and therefore that note needs to go down to 0, and that's a debit balance. I'm going to make it go down by doing the opposite thing to it, which in this case would be a credit for the amount in there, which is 2150. Then we need to figure out the interest. Notice that interest is revenue, so it's got to go up because it always goes up. We loaned money, we earned money on the loan of money just as we would if it was rent, so we have a credit of revenue for the amount that we charge Carson, which we calculated first here. This 2001 loan at 9% means we're charging him $32 in revenue. So I'm just going to say a credit of 32. That's how much we earned in revenue on the loan that we sent out. Then if we add those up, it adds up to 2182. That's how much we got. The loan plus the interest we earned on it, 2182. Could do that with a negative sum function. So I'm just summing those up, adding them, and flipping the sign. Therefore, the debits minus the credits equals 0. Then I'm going to double click on cash, go to the end of it, plus, and make that go up. Then we're going to go to the interest revenue down here. Once again, that's a revenue account, and double click, go to the end of it, plus the 2150, enter. That makes that go. I'm sorry. I posted the note there. The note should be here. I'm going to double click on the note and say, and just so you know, how did I fix that? I hit the undo button. So anytime you go, oh crap, I did something, you know, undo button, and and that doesn't include that number anymore. So then we're going to go to the interest, to the notes receivable here, double click on that, plus this is a debit, that's a credit, making this go down. And then we're going to go to the interest here, so we're off by the 32, and we're going to go to the end of that, plus, and once again, enter. And notice our interest is going up. This is the only thing that's happening here because we're only dealing with the interest on the receivable. We're not recording any of the sales that are being made, but we're earning interest because of the time value of money. All right, and then we're going to say we're earning interest because we're charging rent basically on the use of the money. So then on 11.5, receive payment of principal plus interest from the Moulin. All right, so now we could see that this got paid off with cash. So we're going to say as of 11.5, is cash affected? Yeah, we got cash. So cash is a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. And we don't know how much we got yet, but we know that we got it for this loan. It's on the books. So we're going to say that loan of 8850 now got paid. This needs to go down to 0 because they no longer owe us the money. But that's a debit balance. We're going to do the opposite thing to it, which in this case would be a credit for that amount of 885. Credit 8850. Now, the cash we don't know because we charged interest on it. So we need another credit over here being the interest revenue, the money we earned for loaning out the use of this money. And for Moulin, we did that calculation before, and we came out to the $56. So we're charging, sorry, I was looking at midnight there. Moulin, we charged the $221. So we're going to go over here, we're going to say the negative 221. That means we're owed the 8850 principal plus the 221 or the 9710. We can do that with the negative sum function. So now we know that the debits equal the credits, or the debits minus the credits equals 0. And then we can then post this. I'm going to double click on cash, go to the end of it, plus, go to the cash here and enter. Notes receivable is going to have to go to 0. Going to double click on it, go to the end of it, plus, go to the 8850 and enter. So that goes back down to 0. Then we earned interest, double click, go to the end of it, plus, go to the 221 interest, enter. Back in balance, net income is affected there, goes up because this is a credit in revenue, making it go up. So then we're going to say, and we're not hitting the subsidiary ledger because it wasn't a receivable. All right, last one. December 1st, wrote off privet accounting against allowance for doubtful account. All right, so now this one here, privet, which we have, which remember we put back in the receivable, that's not going to be paid. So we've given up on that one completely. Maybe he went bankrupt or something. He's not going to pay us. So we have to recognize the fact that our receivable is too high by that. At some point, we just got to give up and say, okay, that's not going to happen. So as of 12/1, then this needs to go down. That's a debit balance. We're going to make it go down by doing the opposite thing to it, which is a credit of the 3822. Now we're going to debit something. Now if we were on the direct write-off method, which is not GAAP method, then we would debit bad debt expense. Because what really happened here is we made a sale and now the sale never happened. So you would think that we would debit sales, making it go down. But we never debit sales, so we make another account, which usually we call bad debt expense, to make it go down. But if we did that, notice that what happens here is the matching principle gets violated because of these bad debts. Because we made the sale in the past, like last year, perhaps, or last month, and now we're writing it off this month. So what really happened is the sale was bogus last month. So on an accrual basis, what we want to try to do is match up the bad debt to the actual sales time when it happened. That's impossible to do perfectly. So what we can do is we can estimate it. We can say, well, you know, this is how much revenues generally are uncollectible, and I'm just going to write that off now when we collect the revenue in an attempt to match the bad debt to the date in which the revenue happened. So in this case, we're using the allowance method, meaning we already did that. So larger companies, publicly traded companies, are required to come up with an allowance method because it's an attempt to have the matching principle be correct, even though it's an estimate. A lot of smaller companies, if they don't have a lot of bad debt, or if they're a smaller company, we might not do the allowance method because it's an estimate and it takes more time to do. We might just do the the direct write-off method. So in this case, we already saying we're estimating that somebody's not going to pay us 3.5 in this case. So if I add those up, we got the 41 minus the 3.5. Our current net receivables are 37,822 after what we've already estimated that we're not going to pay. And now, instead of us writing it off, we're just going to reduce the amount that now this person didn't pay. Now we know who's not going to pay us in this case, in this particular case, and we can then move the receivable. So we couldn't write this allowance to the receivable directly because we didn't know who wasn't going to pay us, but we assumed that we weren't going to get paid something, and now we know that this individual didn't pay us. So it's not going to affect net income in this case. So I'm going to then post that by, we can say the bad debt, the allowance is going to go down. That's a contra asset account. Notice it flipped to a positive number now, and that can happen because it's just an estimate. And then I'm going to double click on the receivable and say plus the receivable over here. That's going to go down. And then once again, we need to recognize the fact in the subsidiary that this is going to go down, and that ties out our subsidiary ledger here.